Okay.
Okay, so here we are for financial leadership and management for larger organizations, organizations with annual budgets over three-quarters of a million dollars or more, with the amazing Kay Soul, brought to you by Wiskative and the Washington Coalition of Sexual Assault Programs. So gratitude to them. My role here is just to help facilitate, but Kay will be leading us through the day. We're going to do from now until about 11, some presentation and conversation, and then again from 1:30 to 3, and in between then you'll have some exercises to just pause. She has some great questions for us to think about. I've been jotting down in my little notebook my responses, just to help me absorb, how does this, what her teaching, all of her great lessons, how does this apply to what Wiskative could be doing differently, how we could improve. And this is such a great topic because, in our work, what we know we're working with survivors and what we know running nonprofits and tribal organizations is that it's the money stuff, boy, it's so fraught, right? It's so challenging. And we know that if we are doing our jobs in a good way, then how we make decisions about money is being driven by our missions and our values and our vision for a world where all people can live and love freely without fear. So the money should be in service of that, and not the other way around, which is what so often happens in this nonprofit industrial complex, right? Is that it's the other way around, that we are being driven by the funding streams and the rules. So Kay's going to help us. She's so gifted. Kay has been a leader in the Pacific Northwest for decades and has helped shape the good fortune that we have here in Washington State to have a really flexible state structure that is including the non-competitive formula approach that we have for some of the domestic violence funding. Kay also, among many other things, was one of the founders of the Nonprofit Assistance Center in the King County area, as well as what is formerly Technical Assistance for Communities in Portland, now the Nonprofit Association of Oregon. She's an author, and Kay really has a heart for small organizations or smaller organizations like ours in domestic violence, sexual assault, also in communities of color and refugee and immigrant LGBTQ communities. So we're just and rural communities. So we're so happy to have you, Kay.
Thank you. And it is just really nice to be here. And I told Judy that now I got to work on advancing my slides because this happened yesterday too. They resist. So hold on a second. So I told Judy, people may think this is an odd slide, but I'm feeling like for many of us, particularly for executive directors right now, it's just overwhelming. It's just crashing down on our heads, everything that's happening as we're trying to be sure that our staff are okay and be sure that the survivors are getting the help that they need, deal with our own families and our communities. It's pretty overwhelming. And so one of my hopes for this training and this day is that you can just step out of that world for a few moments and actually think about something else. And now I know I have this strange feeling that sometimes thinking about money and numbers and how to talk about money and numbers can just produce this pleasure, this bliss. But I hope that it will work for you, just not so much that maybe you are in love with numbers and finances, but that just anything, just stepping away from what is coming down on your head for just a little bit of time can really help. So I hope you'll give yourself the luxury, and it will be a luxury, of not looking at your email and not watching your text messages come in, and actually just concentrate on ways that something that we're talking about here could actually be useful to your program. And, we've got our logistics lined up. I think we're pretty good on that. We've got technical support that you can call. And Laurel is actually with us, and she does answer that phone number. I've called her. She does answer it, and she can help you solve technical problems. Judy, is there anything else we should say about the technical problems that people might have?
Well, if you, I think we're good. And I'm going to put Laurel's email address in the chat here in case you need to reach Laurel. Let's see the next one.
Okay.
So we'd love to have you. It looks like most people have figured out the chat and the Q&A. I'll get the Q&A box going here as well. And raise your hand if you want to. We've got a lot, one of the weird things about webinars is that there's not this dialogue, right? So, but I see many people I know in here who I know that you have a lot to say. So we look forward to hearing from you. I also want to just thank and acknowledge Stephanie Condon, who's here from, Chris says she can't connect. Can I send the link again? I will do that just a sec, Chris. So Stephanie Condon is here from Washington State DSHS. She's the Domestic Violence Program Manager. Thank you, Stephanie, for being here and for supporting this training. And folks, if at any point that it makes sense for us just to have DV and SA programs together and not anyone who's a funder, just let us know. And that's fine too. Okay, thanks.
Right, and as Judy mentioned, one of the challenges of webinars is that it can just seem like, well, there's this talking head and she just goes on and on and on. And so we both really want to invite you to disrupt that. And if you are either thinking that is a bizarre idea or I don't really understand what Kay is saying, please chat in, and Judy is going to watch the chat box as we go. And it worked quite well yesterday that as comments came in, she waves her hand and I can see that, and then we stop and we can talk. And we're going to put pause points in the whole presentation where I want to check in with you and be sure that I've heard what you have to say. The other thing I want people to know is that, and you know all about these evaluations that always come at the end, so I'm going to keep going, that our plan for the day is this webinar part is going to end at 11, and then we're going to really ask you, we hope that you will take some time between the morning session and the afternoon session to either do some self-reflection, or even better, if you are able to contact members of your team. I don't know if you're FaceTiming or Zooming with each other or just phoning each other. The kind of ideal way to do these exercises would be for an executive director and a program manager and your fiscal person to actually talk to each other through the series of questions that we've designed. And one of the reasons I hope you'll do it today rather than like put that on the giant stack of things I'll do later is that part of what is in that question exercise piece is a chance to identify areas where you would like some further help. And so as part of what we're doing on this webinar and this training program, I'm going to have some time that I can do one-on-one consultation with some of the participating organizations. And we'll probably do that by Zoom because we're never going to get together, it feels like. And another piece that is going to be available, and we saw people really taking advantage of this yesterday, is if you have a specific question or you would like to explore a way that you're dealing with some of these issues and hear from others about are they doing that too? We're also going to put out a set of email responses to questions that come in. And so I hope you will take that break between the morning and afternoon session to work on the questions, the exercises, and then send some feedback in so that we can get the follow-up email organized and we can get the online consultations organized. So with that, I think we should get started. And I want to thank all of you who responded to the survey. That was very helpful to me. And I've tried to pull together the topics for this session based on what people said in the survey. And we're going to try to get our time to balance right. So, you know, stick with me and don't hesitate to let Judy know if you are worrying, are we going to get to this other piece? We do have a morning and afternoon structure. The morning structure is going to be on cost-centered budgeting and cost allocation and some of the specific requirements that come because some of the money that most of you are receiving, even though you're receiving it through the state, it actually has federal dollars in it, and that makes you bound by a set of federal rules. And so we are going to talk about how those rules impact recovering your administrative costs and the possibility that you would like to move to an indirect cost rate. I noticed in the responses to the survey that we did not have many organizations with an indirect cost rate negotiated with a federal agency. And I'm pretty sure that's because in domestic violence and sexual assault, many people are getting their money through the state or sometimes through local government or through another nonprofit. They don't have the direct federal relationship. Now, so you might be thinking, well, what does this have to do with me? I don't have any direct federal relationships. And the problem is, if you have even one award through the state or through another entity that has federal money in it, you are going to be bound up in some of these requirements, particularly the requirements around cost allocation and administrative cost, and the requirements about time and effort tracking. And I just want to give everybody a little bit of a heads up on one of the issues in the program in the federal requirements, which has to do with program income. And we're seeing states across the country now use some new provisions that VOCA is willing to see used around program income. So I want to say a few words about that so that you can be thinking about that. In the afternoon, actually, Judy and I were talking this morning. I think we're going to flip the order of these topics, and we're going to talk about the financial information for your board and for the executive director and for program managers, really who needs what information and how can you give it to them in a way that is actually going to engage them rather than overwhelm them or space them out. And then after we do that, we'll flip back to the rest of the federal funds compliance topics, and we'll go into just a few more details on that. So that's the plan for the day. And really to get started, the starting point is the reality of doing an organization-wide budget. And as I think you all know, when you use that term, you're talking about putting together a plan for your 12-month fiscal year that includes all sources of funds that you're going to have and all expenses that you're going to have for all purposes over the 12 months. And it sounds sort of easy until you realize that most of our organizations have multiple funding agreements. They have multiple contracts, awards, grants, and they have to integrate all those agreements to produce a comprehensive budget document. And a further complication for those of us in domestic violence and sexual assault and all kinds of victim services is that there are restrictions on the use of funds, and they have to be reflected in our plan. So to get to a starting point for pulling this organization-wide budget together, my own view is you have to start with personnel costs, because for almost all of our organizations, personnel costs are going to be the largest cost element. And if you want to, put your focus where you have the most energy and the most time, it is going to be on working on your personnel budget. Now, there are some things that you're going to have to be dealing with that go beyond personnel and impact personnel as well. And one of those is uncertainty. And you're like, gee, aren't we all dealing with amazing uncertainty right now? But there's a particular kind of financial uncertainty, which is unlike a contract or an agreement where once you and the funder sign off, that really is very close to a guarantee that those funds will be available if you have the allowable expenses. Of course, they're not available if you don't have the expenses. But most of us are now doing a fair amount of community fundraising, donor fundraising. We've got a lot of strategies going on to bring in additional funds. And of course, the characteristic of that money is there is no certainty. You have a track record, but just looking at the disruption that we're going through right now, the past does not always predict the future. Some of us have also begun to have some elements of our work that we are charging fees for, or we're actually entering into contracts with other organizations to provide services. And generally those contracts come down to, if you don't provide the service, you don't get paid, and you're not sure exactly how much service you're going to be asked to provide. So we do have uncertainty, and we have to figure out how to put that into our budget plan. And the other reality that I think all of us are dealing with is that even though we might have started out in a somewhat siloed fashion where we would think of, oh, I've got this award and I'm just going to hire some people to do the work on that, and they're going to work over here and it's all going to be off on their own. Oh, and then I got another award and I'll hire some more people and they'll work over here and they'll be off on their own. We're not doing that anymore. We have many people working in a common space often. They're doing services and activities that are funded through multiple awards. We may have one person who performs 2 or 3 different kinds of services in our organization, and that we are planning to pay through 2 or 3 or 6 different funding agreements. And because of that reality, that need to integrate multiple funding agreements, we're going to end up having to identify costs that benefit more than one activity, more than one award, and learn how to allocate those costs in a way that, first of all, is fair and tells us the truth about how much things cost, and second of all, is compliant with the requirements for supporting the costs that we want to charge to our different awards. So I thought we could start by talking about personnel costs. And, you know, I think it's not possible to do an organization-wide comprehensive budget without putting together a detailed personnel schedule that identifies every position that you're going to have and sort of fills in the plan for that position. And I am showing a sample personnel schedule here, and I'll see if I can get my pointer to come on this morning. It worked yesterday and it worked again today. So you can see this schedule is organized with a line for each position that is going to exist in your organization, a chance for you to figure out whether it's going to be full-time or part-time, and part of that is going to be, is it all 12 months or is it just part of the year? And then what's the base pay that this is going to be planned for this position? So that's just the basics of a personnel schedule, but what makes it useful is the rest of this format. And in this particular format, we're organizing information by our different programs or services, not initially organizing it by the different funding sources. We are going to get to that, but we're starting by saying, well, what are these people going to be doing? Why am I employing them? Well, some of them I'm employing to raise money for us, and some of them I'm employing to do the financial management and the board support, the administrative functions, but other positions are going to be employed to deliver services for perhaps victims of sexual assault, victims of domestic violence, children, and your program structure may divide it down into many more distinct programs, observable services. And what we're showing in this schedule is that once I've said, okay, I'm going to have a position, and I know in this case it's going to be full-time, and I know what I'm going to pay for that position, then the next question is, what is it you are expecting this person to do? And if you are expecting them to split their time between program 1 and program 2, and it's a 50-50 split, that's what we're going to see here. So that's all a lot of detail about something that may may seem very basic, but I wanted to show it to you in this format and so that I could
Okay.
recommend. Yeah.
Can we go back
Go
just
for
for
it.
a second?
Yeah.
So 2 things. I want to just point out, can you go to management in general?
Yeah, over here.
So if anyone's wondering, M&G means management in general. So just FYI. And then,
That's helpful.
yeah.
And you're going to hear me sometimes go back and forth between referring to it as management and referring to it as admin. Now, in some contracts, there is a distinction between those, but for the purposes of this session, I'm going to make them kind of interchangeable. Okay, and Judy, you were going to say something else.
The other thing is that when you said this, it really is, this is a kind of a mind blower, or like a shift, at least for me, of, yes, like part of this whole thing about how are we mission driven rather than being contract driven, is that these columns that you have are the programs. So it's, the DV advocacy, the sexual assault advocacy, the child center, the prevention program, the child advocacy center. It's not DSHS, OCVA, VOCA,
Right.
ESA, etc. And so that was just, oh, oh, and you're going to show later how to have both,
Right.
how to have something that's tracking our work by the budget by program, and then also by funder. So Susie has a question here that says the part-time lines at the bottom. Can you talk about it? It just looks like what I currently use, but I've struggled with this part-time piece.
Well, it'll probably help if I explain. Yeah, it's a good question, and I'll explain what this template is, what this is actually from, what this schedule is actually from. It's from an Excel template that is free, and I would encourage you to take a look at it because those of us who are good with spreadsheets know how to link the different worksheets in a spreadsheet and roll them together in a master budget that is the grand finale, but behind that grand finale, there's schedule of personnel, and there's schedule of each grant that you're going to have, and there's a schedule of each program. There are a lot of other schedules. Well, it is helpful to design your personnel schedule with a distinction between full-time staff and part-time staff. And so it is just what it looks like here, that you're still naming the position, but here you're filling in what is the actual percentage of FTE that you're planning for that position to have. And I think you're getting your master picture of those positions, but you still got to do the same distribution. Why am I having this position? What is the person going to be doing? So I hope that is an answer. I just want to encourage you. Judy said that we're going to talk about looking at the organization-wide budget from a slightly different angle than some organizations have looked at it. Some organizations have been looking at it in terms of, well, I have this award, that award, and another award. We're going to look at it differently, and we're going to look at it in a way that says we have to think both about our programs, our functions, the observable services that we do, because that's what our community is interested in. That's probably what our board can understand, that we have these different programs. But we can't forget that we sign these agreements, and the agreements have budgets, and we have to be able to report on those budgets. And more than that, from a budgeting standpoint, we have to figure out a way to make all those different agreements work together so that we are able to pay for the services that are really important to us, and that we don't get stuck in a siloed mentality. So I want to go a little further on, and then I think you're going to see this distinction, and it may make you think, I just wonder about that. So, a cost center budget is usually done on a spreadsheet, right? It's got columns and rows, and it uses cost centers. And by that, I mean, these rows, these are line items. We got personnel costs, we got professional services, we've got occupancy. Now, this is obviously highly summarized to get it onto a slide. You will have much more detail in yours. But what I hope you won't have in your line items is a structure where you have said, oh, I have professional services. Well, let's see, that's the professional services associated with domestic violence. I'll make another line item for that. The professional services associated with this contract, I'll make another line item for that. That's not necessary, and it's not efficient. What we all have learned over time is that you get your categories into the line items, and then you get your purposes into columns. That's what these are: management, fundraising, advocacy, shelter, the children's program. Yours will go way on over across the page. Or your structure might look like the next slide, which is we've got the line items, and then instead of dividing them into purposes or functions, we're dividing them into the funding agreement. So we had award 1, 2, 3, 4, and we had this column for unrestricted, which is the money that we're going to fundraise. We don't have any guarantees on it, but it's not part of an award. And some of us would have broken that down into multiple columns because we're looking at different strategies to bring in that non-award money. Now, whether you're using this funding agreement approach or whether you're using what I've called functional, meaning there's a fundraising function and an advocacy function, whichever approach you are using, these columns are cost centers. And another way to think about that is they're buckets that you're sorting each type of line item into. So when you think about your personnel costs and you go back to that personnel schedule, you're going to put the personnel who are going to work in management here and in fundraising here and in each of your programs there. Or if you were using the funding agreement cost center approach, you would be putting the personnel that you're paying through award 1 here in award 2. So we're going to use this term cost center a lot, so I want to make sure we've got a common definition of it. Now, the next slide is actually an illustration of the functional approach, and it really looks just like more detail of what we saw in the green slides. It's got the admin or management, it's got the fundraising, and in this example, it has 3 programs. But one of the things I want to talk about and show you is this column over here that is Program C Grant 1. And this is an illustration of a common situation that many of us have multiple funding agreements where the funder merely says, I want to support activity in this programmatic area. And so when we have that kind of funding agreement, we figure out what are the costs of doing program A, and then we put all the different funding sources that are going to be paying for program A. But over here in Program C, we've got a very different situation where we have a funder who says, I'm not satisfied with just saying, put my funds towards Program C. I require you to have a detailed line item budget that I approve and that it represents costs that I've agreed to pay for and that you've agreed to track. And the reality for most of us is, yeah, we've got an agreement like that, but very frequently it is no longer paying the whole cost of Program C. It's paying a portion of the cost, and we still have to figure out a way to pay the rest of the cost for Program C. So we're going to go deeper into this and look at the reality for many of us that it's not just one program that has one restricted grant. It's very likely that each of these programs has one or more restricted grants behind it, and that we're having to combine funding from multiple grants in order to operate these programs. So what we're really looking for is a strategy to look at our costs on 2 levels in 2 frameworks. One of them is a functional framework. Well, was it management? Was it fundraising? Was it Program A, our sexual assault program, or Program B, our shelter program, or Program C, possibly our non-residential service program. So the first question is that functional question, and then the next question we're going to have to deal with is who's going to pay for what, and what kind of tracking do we need to do. So before we get into the details of building this budget, I want to be sure everybody is really clear that there is no point in building a beautiful budget cost center structure if that's not a structure that you're going to be able to use in your accounting and reporting. Because one of the key tools of financial management is we want to compare the budget, our plan for the year, to the accounting and financial statements, what actually happened. And if we're not using the same cost center structure, we can't make that comparison. Now, those of us on the call who are accountants probably are already a little bit ahead of the game in saying, well, wait a minute. I know that in our accounting system, it is totally possible to track costs by line item. You know, was it salaries? Was it supplies? Was it telephone? Everybody does that. We know how to do that. And in our accounting system, we have an account segment that can be used to track the function. Was it for the children's program? Was it for the rural outreach program? So the function can be tracked, and we definitely have a segment in our account codes that tracks the funding source. Was it on this DHSS contract, or was it on this other contract I had from the county? We are always tracking our funding sources. And so if you have fund accounting software like MIP, a lot of us use MIP, you do that through account segments. Pardon?
I think most people, well, this is a good question. Hey, okay, we have 3 questions.
Okay, all right, we'll stop.
One, I would just say, I'm not sure if we have any accountants on the call, so if you are an accountant or a bookkeeper or in that role, please type it in the chat to all panelists and attendees.
Oh, that'd be great.
There's a question of, would you ever use both types of cost centers kind of simultaneously? And I think the answer is yes.
Absolutely. And that's what? Go ahead.
Oh, I was trying to figure it out. Okay, we've got one accountant, one bookkeeper, a director of finance, and an accountant here.
Oh, good.
A financial manager. Great. So
yeah, we've got them.
Both
That's
a
good.
functional structure and a fund source structure, and the answer is yes, because, okay, let me see if I'm getting this, Kay. Because this is kind of like this whole thing of finance people are from Mars, and the program people are from Venus, right? Of that, sometimes that conflict or that kind of way of just seeing the work and the financial information so differently is that that the finance staff are thinking about things from a fund source perspective, and the program staff or directors are thinking of things from a functional perspective, and having both of these things is the way that we can communicate with each other.
Right. We want both views to be reflected in the budget and in the accounting system. And I do want to go back to the reality that some people are using QuickBooks. And in QuickBooks, we can do this too, because we have line items in QuickBooks. We have classes in QuickBooks. And when I set up systems, I usually use the classes to be the functions. This is the sexual assault program. This is the rural remote program. This is the shelter program. I use the classes for that, and I use the customer job feature for funding sources. So this is what I've got in one of my, these are the costs I'm booking for a particular VOCA grant, because I know some of you will have 2 or 3 different VOCA agreements. So this is, VOCA 1, VOCA 2, VOCA 3, I use the customer jobs. But I also know that there are fine bookkeeping systems that say, well, line items are line items. We got that. But we prefer to use the classes for the funding sources and the customer job feature for the functional characteristic. doesn't matter. If either one will work. There's like technical reasons why you might choose one or the other, but we're not going to talk about that. And if you have stepped up because you're larger and you're no longer using QuickBooks and you're using something like MIP or one of the other fund accounting programs, they are built specifically to be able to look at things through two different lenses. In fact, in some of those systems, you can look at costs through 6 different lenses, but we'll be happy with 2 different lenses, first thinking about the function, then thinking about the funding source. Now, we'll go a little deeper, and I think this will get clearer as we go. So this is back to the functional format, and I just want to say a few words about that functional format. Now, if you have, the accountants have been doing this, but for executive directors, if you've been looking at your audited financial statements, you'll see a statement that's called the Statement of Functional Expenses. And what it does is it organizes the information about your expenses, not just by line item, but by function. So there's a column in there that says management and a column that says fundraising, and then there are columns for each of your major programs. And that format, that functional format, also exists on the 990. That's how we're required to report for 990 purposes. So although we may not be having our budget organized this way, and maybe even our accounting system isn't organized this way, at the end of the year, someone is having to convert what we've got into the functional format, because that's what the accountants of the world want to see reported and what the IRS wants to see reported. So I just want to say a little bit about these functional cost centers. And so the benefit of having functional cost centers is it really is an essential tool to figure out the full cost of providing a service, especially a service where you're going to have multiple different funding agreements contributing, and possibly still have to do some local fundraising to cover the full cost of that service. But before you can figure out whether you need to do that fundraising to subsidize what you're getting from your contracts, you have to be able to figure out the full cost. And we're going to spend a few moments looking at that. And once you do figure out the full cost of doing a service, you're going to see in some cases a gap between what the various grant funders or contract funders have agreed to pay towards providing that service and what that service is actually going to cost your organization to provide. And I think those gaps are really interesting, because when we say to our board, we need your help raising money in the community, we need your help getting people to come to our events or getting major donors to give, we are very often asking for their help in closing the gap between what it fully costs us to serve victims of sexual assault or to have outreach into rural communities and what we've been able to get through our contracts. I also think that this format makes the work of the organization clearer. Sometimes I see financial statements that are, and budgets too, that are presented to boards where the columns are lists of contracts, and they've got acronyms by them. And it really is meaningless to people who aren't in this work every day. But if I can see a budget or a financial statement that says sexual assault advocacy, mobile domestic violence services, if I can see words that describe a service that I can understand, that is meaningful to me. And as a board member, I am interested, well, how are we funding that? How are we going to be able to do that so that if the executive director comes to me at some point and says, well, you know, we're getting cutbacks in this area, I can see how that's going to impact our ability to provide whatever kind of service that funding was going into. So I think it encourages kind of a holistic understanding of what we're doing rather than a kind of slice and dice thinking where I know what's in this agreement, I know what's in that agreement and the other agreement, but when I try to talk to the board about it, it just turns into alphabet soup and they check out. So I think there's a lot of benefits. There are challenges in the functional structure, and one of them is you've got funding agreements that require line item tracking, so you're going to have a funding source component, a layer of funding source information, because you have to be in compliance with that. And pulling this together requires integration of multiple funding agreements, and sometimes that is a very challenging thing to do. Now, I want to go a little bit further and say, when I'm talking about the full cost of services, what I mean is that if I want to understand what does it really cost us to operate Program A, and let's say that's our services for children whose families are coping with domestic violence. Let's say that's our Program A. Well, I'm going to hire people who are knowledgeable about working with children who have experienced trauma, and I'm going to pay the cost of a children's room where we put special equipment, probably going to get some training for the staff that work in that children's program, but that is not the total cost of the service, right? Because I have to put it somewhere, and if I'm putting it in a building that has other services, there are some facilities costs that have to be considered part of this, and we better have telephones in there, and we better have computers in there, so there's going to be some of those shared costs, and we're not even going to be able to pull this program off if I don't have financial management, if I don't have a financial management system, the ability to process payroll, the ability to work with the board of directors. So the full cost of Program A is going to include those direct costs plus a share of shared costs plus a share of administrative costs. So what we're trying to do is build a model that tells us what it really costs us to produce each of our programs. So again, this is another way of looking at it. We've got income coming in, maybe from multiple sources. We've got the direct expenses of doing the program. Then we have some allocated expenses, and then we get to the net income. And for some of our programs, that net income is actually going to be a net loss, and we're going to realize that we have to use some of our fundraised income to fill in the gaps. Now, I'm about to shift gears and talk a little bit about, well, what's the benefit of saying my primary cost center structure is funding sources? And in this approach, what we're doing is we're treating each funding agreement as a cost center and putting all the costs that that funding agreement has agreed to cover. And the problem is that we, in many cases, are not going to be able to cover all the costs of what we're doing with those funding agreements. But this is what it would look like, and this is how we would cope with the fact that we have to do some fundraising to cover costs that aren't covered by the different awards. And this is where I really want to go with this. So, the benefit of having a budget structure, cost center structure, or an accounting cost center structure that is focused on funding sources is it certainly does make it easy to compare what actually happened to the funding agreements. And it actually works quite well if all of your programs or services are funded by a single source of funding. So it tends to work well when you're smaller, but as you start getting more and more different funding agreements, then these challenges begin to appear. And one of the big challenges is this cost allocation, that we know that as we saw in, let's go back and look at this slide here, we know that the full cost of doing something is not the direct cost of people who perform the service or the supplies we buy for that program. We have to include the common cost of our facilities, of our telephone systems, our computer systems, the common cost of our management. So the challenge when we're focused solely on funding sources is that they often don't make the cost allocation methods that we're using transparent, because what we show in those award columns is not what is the fair share of this cost that should be assigned to a service. What we're looking at is what is the amount that the budget on this funding source will allow us to spend on that cost item. And what a funder has agreed to pay for a shared cost is not the same thing as what is the fair share of that cost, if what we want to know is what does it really cost us to deliver a particular system, a particular service. Now, the other point that you may or may not be aware that sometimes there are challenges made to cost allocation systems, and there are allegations that the way an organization allocated cost did not meet the fairness test. And one of the values of switching from being primarily focused on a funding source cost center system to moving to a functional cost center system is you actually get greater flexibility in being able to deal with the different requirements of different funding agreements in terms of their willingness to cover certain kinds of costs. And we're going to illustrate that in a minute. Other problem with just doing funding sources is, in the end, you're going to have to produce that statement of functional expenses and the 990. So we're going to have to get there anyhow. And finally, and then I'm going to come back to you, Judy, final challenge or disadvantage is really if all you've got is funding source information, it is very difficult to provide a simple, understandable description of the services you're providing. Now, Judy.
So there's a comment that that the cost allocation method that an organization is using is by staff FTE. So I think we're going to get to the different ways to do cost allocation.
Yeah.
And then I want to just check out to make sure I'm understanding, Kay. I think that what you're saying is that even if we're doing cost allocation, so which of course we're all doing, right? Even if we have a cost allocation method, that the problem that is coming up in some audits or federal monitoring visits, for example, Office of the Inspector General, and just checking out with you, is that if we're allocating costs but we're actually not, I don't even know how to say it.
Well, the challenges that are coming up is that sometimes it happens with your own auditor if you've been required to have what used to be called the A133 audit. Now it's called the single audit. It's the audit because you have more than $750,000 of federal dollars that are flowing through your organization. So sometimes it's happening with the independent auditor who is required to take a look at how you are allocating costs among your different programs and funding agreements, and they see as they do that examination that that the method that you are using, it's an okay method like percentage of FTE, but it has not been used consistently and fairly. And what has happened instead is you've come to a particular agreement and you've said, well, the fair share that we should give to this agreement for this kind of cost would be $10,000, but the funder only agreed to $5,000, so we only charged $5,000. Now that's a violation of the federal cost allocation requirement. You can't make the decision about how much to allocate to a cost center based on the availability of funds. So some of us are having questions raised in audits, and some of the states are finding that when the Inspector General comes in to look at the federal funds that have been given to the state, that there are questions being raised with them. And those questions vary. Sometimes it's about how the state has done their own cost allocation, although that is not what it usually is, because most states have a federally negotiated indirect cost rate, and that's not the point. The questions that seem to be getting raised are, okay, state agency, you have all these subrecipients, all these nonprofits that you are funding and using our federal money to fund, but you are accepting reporting from them and practices from them that are not compliant with the rules. And I was telling Judy yesterday, I've been working on a project in Texas, in a really tiny town out in the middle of nowhere, where there is one nonprofit organization that is providing an amazing array of services, but they really have always been doing the cost allocation wrong. They have always been basing it on what amount different funding awards would pay for different costs. They've had so many audits, they've had so many monitoring visits over a 20-year period. No one has ever objected. But now that the state of Texas has been challenged by the feds about how they are allowing the subrecipients to spend the money, this little organization in this completely isolated town has been found to be totally non-compliant. And it's a terrible situation, because unless they can put together a compliant system, there's no one else there who's going to take those contracts and offer those services. So I feel a certain sense of urgency on this for people who are in rural areas. You know, in urban areas, there's probably another organization that could take over. But in rural areas, there often isn't. So I think it's, you know, I'm a worrier. You might say this is too much worrying, but, you know.
So what do we do?
Yeah.
So, I mean, so now that we're all suitably scared a little bit, so will you talk about, well, then how do we plug those holes? And
yeah, what are we going to do about it?
Figure out what's compliant and what's not?
Right, that's where I'm going.
Okay, great.
Okay, this is just like a background piece. Everybody knows this. You've been to 100 trainings with different government funders that say, you know, oh, when you're going to charge amounts to our agreements, they have to be reasonable, necessary, and allowable, and you know, can only charge costs that occur in the time period of our agreement, and you can only charge the costs that are permitted by our funding agreement. We all know that. But the tough part is the red one. You've got to be able to show that the costs that you are charging to a particular agreement, that cost is actually doing something that leads to the achievement of the purpose of that agreement. And that's the starting point for why we have to do cost allocation and why there are these requirements. So, you know, when you get to this question of, well, how would I demonstrate that a cost benefits a particular cost center? And for the moment, I'm going to talk about that cost center as being a function, a program, or a service. But this same rule would describe a cost center that is a funding award cost center. Well, when you think about the costs that benefit that cost center, there are kind of two kinds of costs. There's direct costs, like that example of the children's program where we hired a skilled children's advocate to work in that program. That's a direct cost. And we bought some toys for the children's room. That's a direct cost. We never have any trouble with the direct costs. The problems are with the shared or common costs, because these are costs that are going to benefit more than one cost center. So if that children's program was actually housed in a shelter and we've got a facility there, well, in that facility, multiple activities are going to go on. Multiple programs are going to go on. Multiple funding agreements are going to be used to support that facility. So all those facility costs, like if we're renting or if we're just paying for utilities and liability insurance on the facility, those are common costs. Same thing with our telephone system, our internet, our copiers. We purchase these things and then they benefit all of our different program activities, and they also benefit our management and fundraising activities. And then the toughest one of all of these is the management, because we have to have overall management for our agency, and that management, including the financial management, is going to benefit every single cost center that we have. And so it's these shared or common costs that we have to figure out an allowable method to allocate among the cost centers that benefit. Now, this slide, I know people just like go blank when they read this federal language, but I think it's important because the feds talk about things in terms of cost objectives, and it really does have a very similar meaning to this term cost center. But the interesting things about how the feds talk about it is they say that whenever they're talking about a cost objective and the rules for allocating costs to a cost objective, it's the recipient, it's you, the nonprofit organization, that gets to decide how you are characterizing your cost centers. Are you going to organize them as programs or as functions or activities, or are you going to organize them by funding awards or contracts? It's up to you. So, you know, if you have always done it by funding awards, and after thinking about it, you think, well, I kind of like to shift over to focus more on programs and functions, know that you are permitted to do that. You just have to do it consistently. And I would say you just have to be really sure that if you're going to switch it over for thinking about your budget, you can switch it over for the way your accounting system works, although that is usually not as hard as it sounds, because most of these accounting systems are actually thinking on both levels, both about purpose, function, and about funding source. So this is basically what we're saying, that once you figure out what you're going to call your cost objective, then you're going to define it, and then you're going to allocate costs to the various cost objectives that benefit from that cost. And the key word here is you're going to allocate them fairly. And fairly does not mean by which funding source will pay for what. So, you know, when you get to, well, how would we do it? You have to use a method that is both reasonable and cost effective. You don't want to come up with a method that's too complicated, because it will not be cost effective. There's a lot of different methods that you can use, and you can use different methods for different types of costs. So you might say, well, for those facilities costs, I'm going to use some sort of percentage of square feet, but for my administrative costs, or even for my telephone costs, I'm going to use percentage of FTE. What you can't do is change methodology for the same type of cost. So I can't say, well, for the purposes of this program, I'm allocating facilities costs by percentage of square feet, but over here in this other cost center, I'm doing it by a different method. You've got to be consistent for similar types of costs. Now, there's some underlying core assumptions, and the one that is really hard to grapple with if you haven't been doing it this way is that every cost center has to be charged a fair share of costs. So you can't say, well, I have this award that doesn't allow anything for facilities, so I'm not charging any facilities to it. If the center, the cost center benefits, it has to get a fair share. Now, you can't cause that funder to pay for something that they won't pay for. You're going to have to fill in that gap. And you can't define a fair share as what some funding agreement said they would contribute to pay for something. So what are the yeah.
So when you said that you're going to have to fill in that fair share, what do you fill it in with? So say you have a county contract, and the county contract is only going to pay for bed nights. It's not going to pay for any of the overhead. So I'm gonna have my cost center is the domestic violence sheltering program.
You're going to figure out what it really costs you to provide a night of shelter. And that's going to include facilities costs, other common costs, a share of your administrative costs, as well as the people who staff the actual shelter. That's going to be the full cost. And with that full cost information, you can figure out, well, when I turn that into bed nights, how much does it cost for each bed night I provide? Now, it's possible that the county's offer is high enough that it does cover what it really costs, but it's more likely that it doesn't, right? And so then probably you're going to have to get unrestricted money. You're going to have to ask for donor contributions. And what you can't do is say, well, you know, I've got another agreement over here that is really generous, and you know, I think they could subsidize the county. Now, maybe they could if both agreements are for the same purpose. They both are an agreement to fund your providing shelter. That could be a real reason to move to a functional format, because while the bed night agreement, that county agreement, might not cover all the costs, you could use this other agreement to fill in the gaps. But if you have structured your cost centers only on funding agreements, then you're not, it's against the rules to take money out of one unrelated funding agreement to subsidize another funding agreement. So it's going to be subsidized with unrestricted money. And we'll look at an example that I think makes that clearer.
This is a really important, this is a really, really important point for our folks. And I want to just make a commercial announcement that part of one of the things that Kay has offered to do is to have one-on-one follow-up appointments. Can you let's just flag that? But if this is something that you're if you're an orange alert right now, jot down what's you know, what you're worried about, and we're going to talk either later today or this afternoon about these follow-up appointments that are going to be available.
Yes, and I also want to say, and also take a deep breath, because remember that your auditor's been coming through there every year. The monitor's been coming every year from the state. Nobody has had any objections so far, so it's not like the sky is falling. But I think it is worth thinking about these things, not just out of, I'm worried that, you know, some auditor is going to have a fit with me, but actually I do worry about that, but I'm much more interested in the value of thinking about financial information in terms of what are we accomplishing? Well, we're accomplishing these services for children, and these services for victims of sexual assault, and these services for people living in rural communities who are experiencing domestic violence. I just think it's so much more useful to do our planning around those services and our discussion around those services than to be, you know, endlessly slicing and dicing and thinking about funding agreements. They're like building blocks, but they're not the finished product. Now, I've used a term here, and I just want to clarify a meaning. I've been talking about agency-wide management or administrative costs. And, you know, that does include all costs of financial management. It does include strategic planning if we're talking about agency-wide strategic planning. It doesn't necessarily include, well, the team members on the Children's Advocacy got together and did some planning for next year's work. That's not what I'm talking about. Board support, that includes the whole cost of recruiting, retaining, organizing, meeting with, so this often involves the executive director. Sometimes there's an executive assistant who's providing board support. Sometimes we're reimbursing board members for travel costs to get to board meetings, or we're providing refreshments. So that's a management cost. And it also includes high-level planning and management for functions like IT and HR. And since you all are from the larger organizations, my guess is you may very well have a director of IT who is not, that's not just the person who you pick up the phone and say, you know, Mary, I can't make the printer work. This is someone who is doing the planning for what is the new technology we're going to need to adopt, when are we going to replace our hardware, how could we improve our use of cloud-based services. They are a planner and a manager. And the same thing on HR. I'm not talking about the person who, maintains the files. I'm talking about someone who is actually negotiating the benefits plans and working on the rewrite of the employment policy. So if you have people functioning in high-level management roles like that, they're going to be considered part of the management of the agency. So now we're talking about, well, how can you allocate those management functions? And I guess I want to start at the bottom of this slide and say, well, some of you have decided the easiest way is I'm going to negotiate a federal indirect cost rate. And to do that, I had to apply to a federal agency that I have a funding agreement with. And we negotiated this rate. And now I am able to just use the rate and not argue with anyone about my methodology for cost allocation for management costs. And those of you who have the federally negotiated rates know that one of the best things that ever happened to us happened with the uniform guidance back in 2014, where the Fed said, hey, if an agency has an indirect cost rate negotiated with a federal agency, all of the state programs have to accept that rate unless they can show that there is statutory language in the federal statute that authorizes their funding that would prevent them from accepting that rate. So life got better for those of us who have indirect cost rates, but based on the survey, I know that's far from everybody. And so what are the rest of us going to do if we don't have an indirect cost rate? Well, we're going to have to make a choice. And some people say, oh, well, why don't I just tell the accountant, the fiscal director, to keep a time record of how they spend their time. And, we have 20 different contracts. She should just write down every time she's thinking of contract number one, get her stopwatch out, notice how long she thinks about that, write it down somewhere. Maybe we could get some software that would do that. That would be absurd. That's not how people do accounting. They do accounting for the whole organization. They produce financial statements for the whole organization. And this is even more ridiculous an idea for an executive director. Let's give the executive director a stopwatch. Let's tell her that as she's talking to the board, she should notice when she seems to be talking about program 1 rather than program 2, and she should click her stopwatch and notice and keep track of the minutes. That would be ridiculous. So this generally doesn't work, with some exceptions. Now, the exception is if I'm the director of finance and I decide to attend a full-day training that one of the funders is offering about the specific requirements for their funding, I do know that I spent a whole day on that funding agreement. So I could do a direct record of that. And the same for the executive director. If I know that I spent a whole day working with the funder of a particular program, I could make a direct record of that. But most of the time that people like executive directors and like fiscal directors spend, it isn't knowable how they spent that time. And so we're going to have some sort of estimating method. And that's what cost allocation is. It's estimating. So common method is that percentage of FTE that someone mentioned. Some people like to do the percentage of direct cost in each cost objective. So if your cost objective is a service, it would be in the service, or maybe it would be the funding agreements. Some auditors will actually suggest for the fiscal people, why don't you do a percentage of transactions? And that is a reference to the fact that some of the more sophisticated accounting software does keep account of how many transactions impacted a particular cost center, and you could turn that into a percentage. I find that to be not a very useful method, but a lot of auditors like it. So the point of this slide is there's a lot of different methods. but there's a lot of challenges too. And one of them is just finding an allocation method that makes sense. Another one is that, you know, our programs aren't stagnant. We keep adding new funding agreements, or a funding agreement ends during the fiscal year. So there's a certain amount of flux in terms of what programs we are managing at any one time. And our cost allocation methodology has to be prepared to deal with those changes, those growths and shrinkages of the different programs that we're doing. It's often pretty hard to explain what we're going to look at in a moment, which is this concept of reporting these costs that are shared cost as direct cost, even though the whole point of allocating is that they aren't direct costs. And I think I can illustrate that probably best with a slide. So let's take a look at this slide. Now, remember I said some of the groups participating today have a federally negotiated indirect cost rate. So they're not going to be doing what we're looking at on this screen. This is for the rest of us who don't have one of those rates. And in this example, this organization is paying rent. It's having an audit. That's an administrative cost. It's paying for its accounting staff. That's an administrative cost. It's paying for utilities, okay? So those are examples of shared or common costs. And so when they're trying to figure out the cost of program 3, 2, and 1, the way they're going to do it is they're going to start with the direct costs, the salaries, the other costs that they can directly associate with those programs. Then they're going to collect up these shared costs for the whole operation. And then they're going to allocate those shared costs in the blue column and making it go to zero, right? Because they've spread it out across all 3 programs. So they divided up the rent this way, the audit this way, the accounting this way, the utilities this way. And when it comes time to report on what are the costs of program 3, they're going to have the direct costs, and then they're going to have these line items that are really allocated costs, but they're going to call the whole thing taken together the direct cost of doing program 3. Now, it always bothers me that I have put a cost down here by allocation, and then I'm going to turn around and call it a direct cost. But that's the way it is when we're doing this kind of cost allocation. And so many of us, if we don't use an indirect cost rate, this is really what we're doing. And the challenge is it may not be very transparent or clear how we're making the decisions about how to divide these costs up. So I'm going to show you another slide that's a budget that illustrates this concept. And then I think we should pause and think about whether that's clear or whether that's still not very clear. So this is sample functional budget. It's organized with a column for admin or management, a column for fundraising, program A, program C, program B, program C. And in fact, we looked at this once before, but now we're going to look at a different element of this. And down here in our costs, you know, occupancy is almost certainly a shared cost, right? Generally we'll have one facility that has multiple program activities going on. It's got our administrators in it, it's got our fundraisers, and it's got people doing program work. And so I have used a cost allocation methodology to allocate this cost among the functions. Now, if you had this spreadsheet live, you would see what that cost allocation methodology was, and I would have put a note by it to say, well, I use square footage or I use percentage of FTE, because when you're budgeting, you always have to leave those notes behind so you can remember what you did. So I did some of the allocations kind of invisibly, kind of along the lines of what we were doing here. I just made those shared costs as a standalone cost center go away and distributed them among the other cost centers. But the one type of cost that I didn't do that with is the administration or management costs. Here I put them into a separate column. They are a distinct function. I'm going to have to do that for my 990 reporting. I'm going to have that information really clear for people who want to talk about what percentage of my total costs are management costs. So I didn't make them disappear through an invisible cost allocation method. I kept them together, but then at the end in my budget, I did allocate them among all the cost centers. And you'll notice that I allocated some of those admin costs to the fundraising too, because you do not do fundraising without management. So I distributed them, and after that distribution, I got to the full cost of each of these functions. And then I was able, down here at the bottom in the support section, and I just pause and say, I know everybody puts the support and revenue, the income at the top, and that's what I do too, but it's easier for the purposes of this slide to put it at the bottom. And you can see what I've done here, which is I've put the different sources of income that are going to pay for Program A by Program A, and the ones that are going to pay for Program B by Program B, and I've totaled them all up, and then I've compared that total in Program A. I compared, well, it looks like I'm going to bring in a total of $225,000 in for a program, at least I think that's what it says, for Program A, but that's not quite enough to cover the full cost. There's going to be a shortfall here, and I'm going to have to fill the gap with my unrestricted money. Now, I'm not going to go into a whole lot of detail about this particular sample budget, but what I do want to say is that as a board member, this is the information I like to discuss in our board discussion of the budget. I am totally prepared to trust that the executive director and the finance person figured out these costs. They worked out the payroll costs. They worked out this stuff. They know about that. I don't know much about it. And I'm also, I'm going to have a little more dialogue with them about how they drew these conclusions about the income categories, especially about this category, individual donations. I really want to understand how did they come up with that number. But if what we're talking about is government grants and contracts, they are the experts on that. So I'm not really going to challenge them on that. What I am really interested in talking about as a board member is you're asking us to help raise money from the community. Why do we need to do that? What are we able to do because we raise that money? And the answer is we're able to keep Program A going. It doesn't take a whole lot of that unrestricted money, but it takes some. We keep Program B going, and we are really keeping Program C afloat. And so I look at that and I think a good board discussion is we just did strategic planning. Does that reflect our priorities? Did we think Program C was the most important thing we were doing? Because we're really heavily subsidizing Program C. So I think that organizing the information this way becomes a tool to engage the board and let them talk about something they actually can understand and know about and have a valid opinion about, rather than thinking that they're supposed to like second guess the staff on the projection of detailed expense categories. Yeah.
So, Kay, this makes me think about one of the conflicts or different points of view that board members often bring, which is, why can't this nonprofit run more like a business, or this organization run more like a business? And that this speaks to what you're just identifying, speaks to one of the things where we can say, actually, here's why, is because in a business, if you are selling hand sanitizer and you're selling more, like the more hand sanitizer you sell, the more money that you make. But what you're pointing out is that actually for human services, sometimes the more money that we make, the more money it costs. Because
very commonly.
And that we need to be able to ideally be able to say, actually, we got this contract where we've decided that it's really, and not just because we got this contract, but we decided as a community that it's really important to have this kind of service. But the funding that we can get for it actually doesn't cover the full cost. And so we have, some decisions to make about, are we agreeing that we can afford to provide this service? And that this is one of the things that happens, especially, many of us have seen when an organization does a big expansion, maybe they build a new shelter, they expand their services,
Right.
they get a bucket load more of money, that, maybe 2 years down the line, they end up abruptly closing, which is a nightmare scenario. And it's because of what you're just pointing out, right? It's because they absorbed they have new money, but that new money came with hidden cost because the new money doesn't cover the full cost of services.
Yes, yes, and I think that's an important aspect of this. There is one other, and I would say it cuts both ways. There's that fact that if we're losing money on this, doing more of it probably means we have a chance to lose more money, but not always directly. And so the one thing I want to point out, because I'm actually working on a board right now where we have this situation, and I think it's going to be relevant to what happens after we start recovering from the virus. Okay, something to notice about the allocation of these administrative costs is that if I had more programs, okay, I might be able to lower the administrative share that each program had to bear. So sometimes growing actually helps with the cost structure because, if you look at this program A, where we didn't need to subsidize them very much, just a little bit, if we had not had to assign $47,000 in administrative costs to them, if we had a bigger base to spread that over, it might have broken even. But that's sort of the optimistic side. The scary side to me is that if what ends up happening as we recover from the virus is that after this big spurt of government, suddenly the government can spare $4 trillion. If we start seeing after that cutbacks, and particularly with state and local government where, they don't have this endless capacity to print more money, if we start seeing our funding shrinking, we really need to do this analysis because we may find that it is generally true that you cannot shrink management costs and other common costs as fast as you can shrink the direct costs of programs. So that's another topic, and it's really going to be worth me. In general, when you are in a cutback situation and you say, look, we're not getting as much money for our child advocacy program, I'm going to have to let staff go. I'm going to have to cut back hours for the staff. I can't send them to this training. So you're cutting the direct cost of that program because your funding has been reduced. But remember, we've allocated a share of the cost of the facility and a share of the cost of our organizational management to that program. And it is much harder to cut. How do we pay half the cost of the facility? Right? We can't. And you could say, well, why don't you let those administrative staff go? But usually the administrative demands do not shrink in a time of cutback. They increase. So this is a really serious topic to be discussing. But first, let's make it through the period with the virus, and maybe the new spirit of being concerned about whether people can eat will continue after the virus, and we can, and we won't see those cutbacks. That's what I'm hoping. Maybe people will, right? Maybe people will discover it's actually a good idea to let everybody survive. I'm hopeful.
So we have one more question here, and then I know that we're also getting up on time.
Yeah, we are.
So one of the questions was, just thinking about the board. For accounting purposes, having a source cost center structure. So having cost centers be the funding sources, that fits with the accounting system. And then Kay's part of what you're saying is that having a program cost center budget format helps people understand better, like why we're doing what we're doing, and that it helps us be mission driven and not just funding source driven.
Yes.
Okay.
And actually, these two last exhibits that I think we'll have time to look at are probably going to illustrate that point. Now, this is another version of the functional. We've got the programs, the admin, and shared costs. And in this one, you can see me allocating the shared cost and see me allocating the admin cost to get to the full cost of the programs. But what's behind something like this, a system like this, is that you also have to have built a schedule for Program A that looks at the different sources that are going to pay for Program A. So here we have government grants, that's a private grant like a foundation grant, and here's this unrestricted money that we've been talking about raising. So it's not like it's an either or. You really need both the funding source layout and the functional or program layout. You need them both. It's just which one do you bring to the foreground for a discussion with the board or with the community, with donors, and which one is in the background where the fiscal person and the executive director is working to make these pieces fit together. And I'll just say one more thing, and then I know we're going to need to wrap up, and that is one of the beauties of thinking like this, sort of seeing our cost objective as the program, is that when it comes time to do the allocation of shared cost, the rules about fairness, they apply on the cost center level. So this whole program level, this is where we have to decide whether that allocation is fair compared to what we're allocating to programs B and C and fundraising. We don't have to think about it on a grant by grant basis. So sometimes this is the real flex room, because if I've got a particular funding source that says, no, we don't pay any shared costs, we don't pay any administrative costs, but I've chosen the function to be my cost objective where I'm going to be tested on my fairness, I may be able to get a fair distribution of a shared cost and take what I can get from these different funding sources. That's a lot to think about. And I'm looking at the time and I'm realizing that we are not going to make it through all our slides. I think we might want to look at just one more, because I know that we have people with federally negotiated rates. And I just want to be sure that we don't leave people with confusion on this. So you might have a federally negotiated rate. You know that the uniform guidance, the federal rules, give states and other pass-throughs the authority to negotiate indirect cost rates with their subrecipients. I don't believe that in Washington any of the state agencies have chosen to do that, but there is a movement across the states for pass-through entities to begin negotiating rates with their subrecipients. And I think that could be very helpful. That's a sort of future topic to talk about. And finally, I just want to acknowledge that we do have the de minimis rate, and that if some of you are using the de minimis rate, I'm happy to talk with you about that. I find that there are many mistakes made in the use of the de minimis rate. And so it probably is worth talking about. And one of the things, if you flip on through the slides on your own, you're going to see is that I'm inviting you to email me if you are particularly interested in this concept of indirect cost rates, whether you're interested in a federally negotiated rate or in using the de minimis rate. I have slide decks that I can share with you that go through a lot of detail about what the advantages of using a rate is and how you would do it, how you would go about calculating it. And I think where we can stop here, actually, probably one more slide and we'll stop, is just to say, this has been a kind of intense discussion where we've been talking about different structures for allocating costs. And that's complex in and of itself, but there's another level of complexity that your organization is probably going to need to think about, and that is if you are currently using this direct charge method. This is talking specifically around the administrative costs. What you're really doing is you are allocating cost items based on some estimate of the benefit provided to each cost center. And you got to justify that method, and you got to have a written cost allocation plan that explains not just, well, why is this the method that we're using, but demonstrates how you're going to do it, how you're actually going to allocate those costs. So that's a whole system of how to handle these costs that benefit multiple cost centers. There is a different system that you may choose to use that says, I just don't want to argue about a cost allocation method for all these different types of costs and then have someone tell me that wasn't fair. I just want to get a ruling that from someone in authority that says this percentage, if you just apply this percentage to a base in each of your cost centers, we're going to be fine with it. So I do think in terms of certainty and uncertainty, moving towards an indirect cost rate can add a little bit of certainty for some of us. And where I think we'll stop is right here with this offer. If you're just interested in this whole subject of how do I deal with common cost or shared cost or administrative cost, how do I actually think about what is a fair share of those costs to assign to each program or function or to assign to each funding award, this website that the California Association of Nonprofits has put up and keeps adding to it has just an incredible array of discussions of this topic. So if you're looking for background information, it's a great place to go. And then if you want some more specific examples of indirect cost rates, including the de minimis rate, just email me and I'll send you some of my slide decks, and they're pretty self-explanatory as you go through them. Now, I know we've run out of time without getting to some of the other things that I think are pretty important. And so I would invite you during this next period where you're going to be having a discussion with someone from your organization to go ahead and run through the remaining slides and take a look at them. And if you would, if you have questions about those remaining slides, if you could either chat those into Judy or email them to me while you're taking this break, that'll help us decide how much time do we want to spend on reviewing that stuff versus just going right ahead into our plan for the afternoon. And it may be that what your question is something that I can just respond to in an email, and we won't take that time. So Judy, do you think that'll work?
Mm-hmm.
Discussion questions for your team.
Yes.
That's
Okay.
what we're hoping you're going to work on.
So,
Yay,
here
she did
are
it.
questions for us to think about between now and 1:30. So you can do a little bit of homework just to help us absorb these thoughts. Great. Okay.
That sound right?
Good. Okay, and then take it away, Kay.
Okay. All righty. Well, so we're back again. This is the second half. And, you know, in terms of my goal, I'm hoping that over the course of the afternoon, you'll move from being sort of potentially in this position after the morning, just being a little bit puzzled and wondering, to actually having this you know, not just a moment of bliss, actually a moment of ecstasy when it all goes together and you are ready to jump for joy and you would say, that is the best stress reliever I possibly could have had in the midst of all this crisis. So that's what I'm aiming for. And, you know, the sheep might not get quite off the ground that high, but I have hopes. So that's what we're trying for. And one of the things that Judy helped me figure out at the end of the last session is that we probably have the topics on the agenda reversed in terms of the level of interest and sort of want to get people while they're fresh. So what I'm going to do, even though I know this is confusing if you're following along on printed out versions of the slides, I'm actually going to advance the slides through to the essential financial information, and we're going to talk about that first, and then we'll come back to some of the federal funds issues for the people who are most interested in that. So we're just going to flip through some slides, blind you with flipping through the slides, and here we are. We're now ready to talk about essential financial information. And just like we did this morning, I just want to invite you, if you hear me saying things that you think are just strange, or you would never do it that way, or maybe you would say, well, I could do it that way, but I have a better way, please do chat it in. Judy's watching the chat while I'm talking, and you saw her waving her hand at different points to say, okay, we've got some comments or some questions. So that would be very, very helpful if you would do that as we go along. I also just want to remind you that if you just want to keep following while we're going along, but when we get done, you have an immediate question, feel free to email just while it's on your mind, and I will try to respond to it while it's fresh. And then also remember that opportunity for more of an extended consultation. So one of the things that Judy knows about me is that in addition to having worked with nonprofits for years and years, both as an executive director and as a consultant, a lot on financial issues, I'm also a board member. I'm sort of a compulsive board member. I'm always on at least one board. And so I have very strong feelings about what information board members really need to do their job well. And it probably would help to sort of understand where I'm coming from to know that I really see the board having a very critical role in setting the mission and highest level priorities for the organization. Because I have a lot of faith that if you pull people together from the community, they are going to have an understanding of what is really most important, what is needed. I know in a lot of our programs we're bringing survivors onto the board. They are going to have quite an informed opinion about what is important, what is most needed. And so I think that that role of the board in setting high-level priorities is a key role. And really, the phrase, no money, no mission, I mean, we can talk about priorities, but if we can't get our money organized so that we actually can pay for the things that are most important, it's kind of an abstract discussion. So that's one key role of the board. And the other key role that I see is oversight, and I take it really seriously as a board member that I've actually made a promise. I live in Oregon, so I've made a promise to the state of Oregon that through my board service and all of us as a board together, we are going to ensure that the organization uses its resources wisely and uses them only for the purposes of our mission. And in order to, and we also, I feel, have a commitment when it's something like domestic violence or sexual assault, where, I mean, we all dream of a time when we wouldn't be needed, but the reality is we're going to be needed for a long time. And so I feel that as a board, we are committed to keeping the organization going and making sure those services are available. So I'm very interested in our role in financial oversight as it pertains to being sure we're operating lawfully, being sure we're using our resources wisely, and being sure sure that we are going to be capable of sustaining our operation. So if you start from that perspective of why do board members need financial information, it's so they can fulfill those roles. And this is my hit list, and when I am asked to join a new board, I always ask to see the financial information that's being given to board members, and this is what I'm looking for. I really want to see that every set of financial reports includes the balance sheet, and we're going to look at a sample of that with the assets and the liabilities and the net assets. I want to see an organization-wide statement of activities, or some people would call that a statement of revenues and expenses. Because you all are from the larger organizations, I probably would also want to see a revenue and expense statement that shows the cost center activity like we were talking about in the budgeting. And it's really kind of pointless to look at the financial information about what happened in a current month or in the year to date if we can't compare it meaningfully to the budget that we spent the morning developing. And then finally, I am a huge fan of year-end projections. And unlike information about the actual revenues and expenses that have occurred in a month or in the year to date, year-end projections don't come out of the accounting system. They come out of the insight of the executive director and the finance person and sometimes other people who are really looking at financial information and thinking about what's going to be the end of the story by the time we get to the end of our fiscal year. And actually, in the break between these two sessions, I was talking with the executive director for an organization that I am the treasurer for. And my question to him, we're having a finance committee meeting next week, and my question is, have you been able to pull together year-end projections for us? Because I know our finance committee members are going to want to know what you think is going to have happened by the end of our fiscal year. So we're going to look at samples of all of these, and then we're going to switch gears and talk about, fine, that's good for the board, but what about the executive director and what about program managers? Because my view is they have some different needs from the board. So this is a balance sheet, and you know, one of the things that drives people just bonkers about accountants is that we use terminology in ways that confuses people, because I just called this a balance sheet, but you can see right at the top of the statement, it says the statement of financial position. That's two names for essentially the same thing, and what that thing is, it tells us about the assets, tells us about the liabilities, and it really, most importantly, it tells us about the net assets. And if you're using QuickBooks and you haven't had anybody change the captions on the statements, you may be seeing this captioned equity, or if your QuickBooks was set up a long time ago, you might see it captioned fund balance. But today we talk about net assets. Same concept. It's a net worth concept. And one of the things that I've realized as a board member is that if you just give me one column worth of information, this is where things stood at the end of the last month, it doesn't really make a whole lot of sense to me. I have to have a point of comparison. And in this example, this was the end of the last fiscal year. Now we're finishing our first quarter, and I'm going to be able to see what the change was between the cash at the beginning of our fiscal year and the cash now after a quarter. And boy, first glance, it looks like the cash went way down. And I'm also going to be able to see the change in the receivables, what others owe to us. Probably these are reimbursement contracts where we've sent in our record of expenses and asked to be reimbursed, and the payment hasn't come yet. So looking at this, I would say, whoa, look at that. The receivables have gone up significantly. So comparison is very helpful. So in terms of, well, what do I look at when I get this balance sheet? Well, the first thing I do look at is cash, because I think, you know, maybe this is like past trauma or something, but I have been involved with nonprofits that have trouble with cash. They do not have enough cash at certain times to meet payroll or to meet other expenses. So I am always concerned about the question, do we have enough cash? And we're going to talk a little bit more about that question of, is it enough? But as a starting point, I need to know, well, what is it? So I do look at cash first. And the next thing I look at is actually down here in the unrestricted net assets. That's this net worth concept, because I really want to have an understanding of what kind of cushion we have should adversity come our way. And certainly going through all this health crisis, that's adversity. And so I want to understand what we have to fall back on, which is more than simply understanding how much cash did we have in the bank on a particular date. This number, this unrestricted net assets, really is the measurement of our underlying financial strength. And so I pay a lot of attention to whether it's going up, as it did in this example, or going down. So I pay attention to that. The other thing I pay attention to is the temporarily restricted net assets. And actually, we've had a language change so that later on, you'll see slides where I refer to this by its new name, which is net assets with donor restrictions. And I'm interested in this because I want to understand, what have we been given? What have we accepted with donor restrictions? Now, we're going to talk in a little while about the fact that because of some new accounting rules, the way that we probably often talk about our money, like we have all these government contracts, and we talk about those contracts as being restricted because they are, in the sense that they can only be used for certain types of expenses and certain purposes. But for the accountants of the world, that's not quite what they mean by being restricted. So we're going to get into that. For right now, what I'm assuming, looking at this, is that I'm not talking about government money. I'm talking about foundation money. So if you have been able to receive some multi-year foundation grants, this might be where you're seeing a reflection that, well, last year we received some foundation grants. We recorded them because we had to record them, but we haven't yet used the money for the purpose that it was given to us for. So I'm interested in what are our obligations to donors and funders that we're going to have to fulfill going forward. So that's a very quick look at the balance sheet, and I really find that it's the most useful way for me to start a discussion with the board when I'm presenting the financial statements, to remind people of both our financial strength and our financial weakness. So for example, in the organization I'm on the board of, we've been in a declining cash position. So I want to be sure board members are aware that our cash is dropping and we have concerns about it. But I also don't want them to get overly concerned because we have a very positive net asset position. We have a lot of net worth, including, like this organization, we own several buildings, and that is part of our net worth. Now, you can't pay the payroll with a building, but it does give you some financial security. So hopefully you are presenting to your board a nice, clean balance sheet that gives a point of comparison. Now, when I use that phrase, a clean balance sheet, what do I mean? Well, I really mean it's on one page. I find most people cannot carry information over from page to page and have it mean anything. Now, this doesn't mean that this organization in its chart of accounts only has like less than 20 line items. It means that they are summarizing so that they can get this into a concise one-page presentation with a lot of white space so that people can actually read it. And I'm going to go on to that. This is what I just said. This is what we are looking for on the balance sheet. And now we're going to talk about, those net assets, because if you think about that as your cushion, your net worth, then to me, it's pretty obvious that a key goal for the organization is to increase the net assets so that we have more security, so that we can withstand adversity. And so the question that every board member should understand is, how do we grow net assets? And the answer to that question is, well, you grow net assets by way of your revenue and expenses. And if you find that you're able to have revenues exceed expenses, you're going to have positive net income. And that net income, when you add it on to your opening net worth, net assets, it's going to make the ending net assets get bigger. On the other hand, if you have a hard year and your expenses exceed the revenues, you're going to have a net loss, and the impact of that is going to be to reduce the ending net assets. So hopefully every board member understands that relationship. And you don't want board members thinking, well, the bottom line is all that matters. Was it a profit or loss? Because that's not true. We want to be sure we're spending our resources in ways that are going to further our mission, but they should be aware of what the consequences of either having a profit, that is a positive net income, or a loss.
Hey, Kay,
and now we're
Can we go back to the balance sheet?
Yeah.
So a couple other things that will be different hopefully your board members or governing body is very interested all of a sudden, if they haven't been before, on your financial position. And one of the things that's different, again, for nonprofits versus a for-profit business is the accounts payable. In that most of us were very dependent on a quarterly or another time period of having we don't get paid right away, so it's not like you make sales and you get paid immediately. It's that you have to you have to have enough cash flow to front maybe 3 months and then get paid. So paying attention to the accounts payable. Thank you, Kay.
Well, also, I mean, those receivables were waiting to be paid, but one of the impacts where because we didn't get paid quickly, because we had to wait a couple of months to collect our receivables, I do pay attention to the payables, because what's the consequence of that? Well, if I don't have enough cash, I'm going to fall behind in paying my bills, so I'm going to see the payables get larger. And this is a pattern that all goes together. The cash is falling, the receivables are increasing, and we're going slow in paying our bills. So board members need to be aware when that's happening. Now, this difference in this sample between 170 and 180, that doesn't really bother me. That's a normal fluctuation. But if I saw these payables shooting up to $400,000, then I would be concerned that what are we doing to people in our community? Because we're usually buying things locally, and if we don't pay on time, we're creating a problem in the community, and the board has an interest in that.
Especially in a small town.
Yeah, especially in a small town. Yeah, I think Judy's heard me tell this story about a group I worked with that was in a very small town on a coast, and actually the staff told me first, and then the board told me that they were so far behind in paying their main suppliers in their community that people said, I don't want to go to the grocery store anymore because the manager says to me, are you guys ever going to pay your bill? So, it's a serious thing in a small community. Okay, well, let's look at how we're going to, we looked at the balance sheet. Now, this statement of activities, which has the revenues and expenses on it, I mean, a lot of people sort of want to start there. A lot of board members have been trained, oh, I'd better look at the actual expenses and compare them to the budget. And if they're out of line with the budget, I got to push on why is that and question every line item about that. I actually don't think that's the point of looking at the statement of activities. I want to be able to rely on the executive director and the managers to be making good decisions about spending money and to being sure that we are spending funds on our restricted grants in the way that we're supposed to. I think there's other information that as a board member I really need to have. And so here's my personal list. I do want to be aware of the organization-wide net income, and that's because I know that's going to change our net assets, either increase or decrease. I am particularly interested, remember we talked this morning in budgeting, I am particularly interested in paying attention to the income line items that are uncertain. Because, if we predicted that we were going to bring in $200,000 in fundraised income, maybe we have a big event and we do a year-end appeal, there's no guarantee on that. So I want to watch to be sure that we are hitting our targets. I am interested in cost overruns or under expenditures, although when I look at the organization as a whole, and we're going to look at a sample that is organization-wide, I can't tell a whole lot by looking at the organization as a whole. I'm going to have to get down to the cost center information to really understand what is happening in terms of costs being a lot higher than we planned or costs being a lot lower than we had planned. Because actually, when I've got a lot of governmental awards, I'm as concerned about under expenditure as I might be about over expenditure, because usually in a government award situation, if you're under expending against the plan for that budget, there's a chance that you've had something happen like a position go vacant and you haven't been able to fill it, or something else is happening that might disturb your ability to deliver the services that you were supposed to deliver. So that's as much a problem as overruns. And finally, my favorite thing that I'm looking for is, has the management of the organization, the executive director, working with the fiscal person, working with, if there is a fundraising person, that person, have they predicted where we're going to be by the end of the year? So let's look at an example. In this example, we've got the revenues, line items here, we've got the expenses here, and the difference between the unrestricted revenues and the unrestricted expenses turned out to be an increase, $10,000 increase, and you probably remember that from the balance sheet. I'll go back and we can look at that. Remember that I said, it's interesting, we did see an increase in the unrestricted net assets. It went from $1,121,000 to $1,331,000. Well, that change is exactly what I'm seeing here. That change happened because our income exceeded our expenses. Now, in this example, I just showed where we were year to date. So this is the first 3 months of the year. What were the income items? What were the expense items? And what was the net? And I compared that to the annual budget. And then I used percentages. I said, well, okay, what percentage of our plan for the governmental grants, we got 140,000 over 330, what percentage is that? And it turned out it was 22%. So I like to look at these percentages, but I know that some people prefer to use what's called a variance, where they would just say, okay, this is how much we got in the first quarter. We think we're going to get 630 throughout the year. How much does that mean we have yet to get? How much is left in terms of a variance amount? it's really personal preference, which you like better. Some people like, instead of using an annual budget, they like to use what's called a year-to-date budget, which would mean that I took this annual budget that the board approved and I figured out, well, how much of each of these revenue line items is going to have happened by the first quarter, and how much of these 12 months worth of expenses will have happened by the end of the first quarter. And so instead of showing the 12-month annual budget, I would show the first quarter's budget. And that can be useful unless what you've done is divide these numbers by 12 and then multiply by 3, because that's kind of nothing. That is no more helpful than the annual budget. So how do you actually do this? Well, people who like the year-to-date budget idea, they do start by dividing by 12, but then they say, which are the line items that are seasonal? They're sensitive to different times of the year. For example, this event, they have a big fundraising event. Well, it probably only happens one time during the year. So if you're not expecting it to happen in the first quarter, you wouldn't put it in the first quarter's budget. So that's just preference in how you display it. This is the piece that I think is really valuable, because I can look at where we are. Oh, look, we have income exceeding expense by $10,000, and I can look at what our plan was. Our budget plan was that we were going to have income exceed expense by $25,000. And so my question is, well, what's really going to have happened by the end of the year? And that's what the projection is. This is what I'm now predicting the income would be, what I'm predicting the expenses would be, and what I'm predicting is that we're still going to be in the black, but it's not going to be quite as good as I had thought when I was predicting $25,000. So does that make sense, or questions on that? I just pause a little bit before we roll on.
Is anyone doing anything like this? You could write in the chat. One of the things I'll point out, when Kay first showed this to me, it really blew my mind, because I've never seen, again, when you talked about, oh, look, Nancy says yes. I'd never seen statements that did not just have the data that was the QuickBooks data, for example, but also that it's this last column of what is the prediction, the projection. So one of the things I want to point out here is that this is the financial data that an accounting staff person or a financial staff person generated and then put into an Excel spreadsheet. Right? And did these calculations that it's the percentages, and then the ED or program director, whomever worked with, said, well, here's where I am actually projecting, because of course the budget is just a plan, right? And so it's always going to be kind of behind where we actually are. So you might have passed your annual budget, but now that things have changed, your end-year projections might end up being different than they were like even a few months ago.
Right, and it's kind of the natural ebb and flow. Comment?
There's a comment saying, what's the process for coming up with the year-end projection?
Right. Well, for one thing, it's a lot easier to do after you get through the first 6 months of the year. And so when I'm doing the one for this first quarter, I don't get too worked up about it, other than suppose I had learned in the first quarter that a governmental source that we were counting on, and it's just not going to happen. Or a foundation source that we were counting on. I put it in the budget. I was sure we were going to get this $30,000. But what if I'd already heard from the funder, and the funder had said, yes, we're making an award, but no, it's not 30, it's 20. So I already have that information. So when I'm in the first quarter of the year, I'm mostly updating just by things that have happened that would tell me that my assumptions that I had in the annual budget are not going to come to fruition. I wouldn't be too much worrying about, contributions. Are we going to hit our target? Unless I had real, at some real certainty that we had overestimated the target. For example, if our way of asking for gifts usually produces 50% of all we're going to get in the first quarter, and here I can see that we're only at 25%, there is a good chance we are not going to hit the target. So you'll have more information as the year rolls on, but sometimes people have asked me, well, you know, we were budgeting for that grant and we found out we're not going to get it. Do I need to revise the whole organization's budget now? And it depends, but in general, I don't think we do want to keep revising the budget month by month by month. I think we want to stick to our budget because that was our plan, but I want a way of informing people when I know the plan is not going to work. And, you know, one of the common things that has happened to me is we did our best in budgeting, but we hadn't had the final bid on the health insurance plan at the time we did the budget. Final bid comes in on one of these years where it's soaring, and there's going to be, you know, a $50,000 extra cost for health insurance. Well, I might as well put it into the projection so people can see it. And as a board member, my question is going to be, okay, that's reality. We're going to have to deal with that. What is the executive director's recommendation about how to deal with that? That's what I'm really seeing in the projection. And I know a lot of executive directors feel like, well, I report that stuff to the board. Like I reported that the health insurance came in higher, and I reported that that foundation came in at only $20,000 rather than $30,000. And they did, but you got to understand that when you're a board member and you have a lot of other stuff going on in your life, this sort of series of notes about things that happened, it's very hard to hold it together to understand what it all means together. So this is a way to put it down so that everybody can understand it and see it together.
That's great.
Now
That's great. And when I think about our values and, you know, around leadership, I think about here that the value of transparency. So the transparency, so it's not all in our heads, but that we're able to say, you know, here's it's written down in a pretty simple way about transparently where I think we're going to end up, and that can also relieve stress for financial decision makers to not be the only ones who know, but that we find ways of saying, you know, as we transparently share out information, then the responsibility and accountability gets shared as well. So I think I want to just keep us going because I know you've got a lot to cover, Kay.
Yeah. And actually, I'm not going to spend a lot of time on this slide because I know from the survey that many of you are not really dealing heavily with funds that are restricted from the viewpoint of the accounting profession, that is the restricted foundation grants. And I want to get into some other things I think that will probably sidetrack us. I'm happy to talk to you about the odd thing you probably noticed here, which is that I have put the temporarily restricted activity down below the unrestricted. But I'm going to assume that that is of interest to only a portion of our audience, and that's probably a good thing to just talk about offline. I want to instead talk about this, which is, you know, you might have been looking at that statement of activities that I had, and particularly if you're an executive director, I mean, I have a feeling that as an executive director, if I thought this is the only information I'm going to have, I would feel like, well, this is hopeless because I have responsibilities with all these different grants and awards, and this doesn't really give me any information about how we're doing with those different grants and awards. That's true. That's not what it's for. It's really for understanding what's happening as a whole. So to get down to more understanding of what is happening in our different cost centers. And remember, this morning we talked about a cost center budget that was structured by function. Well, here we have the financial report that parallels that structure. So it looks at revenues and expenses, and it says, let's put them in columns. Let's look at administration, fundraising, and our 3 programs. Let's look at the income that came in for those programs and for fundraising, and then let's look at the costs that were incurred in those functions and where we're going with all this information after we've looked at the income, we've looked at the expense, we've allocated those shared costs that we talked about this morning, the occupancy, and in this case we allocated depreciation, and then we allocated administrative expense, and then we got the total expenses after allocation, and finally we subtracted the total expenses from the total income, and we saw not only that the organization as a whole had a net income of $10,000, but that what was really going on was that over here in Program Z, we had a shortfall of $18,000, and the way we covered that is that we used some of those unrestricted contributions that we raised through fundraising and through working with our donors. And this kind of goes back to what we were saying in that functional budget, that it really is a board responsibility to be thinking about what is it worthwhile to use the unrestricted contributions that we're able to raise. What's it really worthwhile to use that money for? Which gaps do we want to close? And so just glancing at this, I would say, well, it looks like they think it's pretty important to close the gap between the funding they're able to obtain for Program Z and the full cost of Program Z, to close that gap with their fundraised income. So this is another statement that the board might like to see. I would kind of emphasize the first statement of activities, which pulled everything together. And, you know, one of the challenges that we're dealing with is that people cannot take in financial information that has 16 columns going across the page. It's just meaningless. And so you've got to pick your shots. And so this is the big overview that has the projection and the comparison to budget. And here we're getting it broken down by function, but there's not really a good place to put budget information for Program Z or Program Y or Program X. And if we did insert columns to say, well, here was the budget for Program X and the budget for Program Y, we're getting into, you know, the 16 columns across the page that no one can read. So what's important to know is that your accounting software, once you have set up your structure for your line items, which we talked about, and for your functions or for your funding source cost centers, once you've put that in the structure of your accounting system, in addition to producing a report like this, which is showing what's happening in the organization as a whole, you could run a report for just Program X. And if you wanted that report to take on this format, what was the budget for Program X for the first quarter, what actually happened in Program X for the first quarter, what percentage of the budget was realized, and what are we projecting for year end in Program X, you could do it because you have the information in your accounting system. And if you did your budget in that same way, you would have the budget information for comparison. So, you know, it might be tempting, because we can do it, to say, well, okay, we'll give the board this report, and then let's also print out a separate report for fundraising for Program X, Program Y, Program Z. You probably have 10 programs, so you're going to have 10 of these reports, and let's give the board this packet of 20 pages of financial information, which I would say, don't do it. People can't take it all in. Maybe the finance committee needs that. Definitely the executive director needs that. They need to be able to drill down and understand what's happening in each of these programs. But I'm not quite convinced that the whole board needs that level of detail. And what I've done instead is go with this more summary level as our standard board statement. And then if we're having problems in a particular budget, something has gone haywire in one of our programs, I'll produce the report just for that program, and we'll talk about that detailed report. But a lot of this is less is more. That's really the guiding principle here. So what do I hope people will get from this statement? Well, I hope they're going to keep in mind the relative significance of each cost center and also understand the contribution to overhead that our different cost centers are making. And another way to look at that statement is that, you know, when I get the subtotal before I allocate the administrative expenses, right, before I do this final allocation, I am actually able to compare how close did we come to covering the full cost of this program with the income that it generates. And often, as we saw in the budget, where the shortfall comes from is we just couldn't get enough funding to cover the fair share of administrative expenses. So sometimes I can make that clearer on this statement. You know, in terms of the year-end projection by cost center, I do think that's useful. In fact, that's how you're going to build the year-end projection for the whole organization. But you're not going to be able to show it unless you are printing out a separate cost center report. And in that cost center report, you would have the comparison to budget and the projection. And I'm about to switch gears from talking about the board now to talking about manager needs. So I want to pause and say, any thoughts on what you're giving your board, ideas of other information you think the board should be seeing? I know when I talk with some organizations that have multiple governmental contracts, they're very used to giving board members kind of a tally that goes grant by grant, and sometimes it'll be set up by, you know, the lists of grants go down the page, and then one column is the income and the other column is the expense year to date. I think that kind of usually not terribly helpful because most of these grants are set up as cost reimbursement. So, you know, if it's going to turn out to be the same number pretty consistently unless there's something odd about how the payment is occurring. And I don't think that report is really a good way to deal with issues that have to do with the payment. That's a different question. When did we collect the money? Did we collect it in advance? Did we collect it after the fact? I think the place to deal with that issue about how did we collect the money on these different awards, that's on the balance sheet where we have the receivables and the payables. And, you know, I just want to flip back for a moment to that balance sheet that we looked at because it was highly summarized. Look at how it's all grouped together there in one line for receivables. You know, if we really were having a problem with collecting on some of our awards, our cost reimbursement awards, I might produce a separate report that breaks out the receivables by the name of the different contracts that we're waiting on so that I could see, well, which one is the problem? Are they all a problem, or are there just a few that it seems to have slowed down? But I'm not sure that the full board needs to discuss that. That's more of a management issue. It might be a finance committee issue. So just a thought on that.
Well, Kay,
yeah.
Can we go back one more time? So
I'm blinding
not
people.
sure if we talked about our burn rate.
Yeah, so we didn't. That's good. So the cash position, how much cash is enough cash? You know, I can't say to everybody on this call, oh, you have to have $200,000 because I don't know what your expenses are. I don't know how much cash you burn through in a month. So for me to say, well, how much cash is enough cash, what I really need to know is both what is your annual expense budget and what has been your experience in terms of how much cash do you have to pay out every month. Because there is a general principle here that we would like to see that we have enough cash on hand to cover a couple of months of operation. And I would like to see that my unrestricted net assets that are actually available for operations, not tied up in my building, is enough to cover us for at least 3 months. Now, these people do not have that. You know, they have $31,000 in available for operations net assets. So they are not protected, but at least they have some cash. But before we could say, well, how good or bad is that, we'd have to take a look at their expenses. And so let's see what their annual expense budget. Their annual expense budget in this organization is just under $1 million. So if you think about that as, you know, well, how much does that mean they go through in a month? Well, something under $100,000. And what if they got at this point? Well, they had $160,000. So they didn't have 2 months worth of cash. They probably had a little more than a month and a half. So a lot of organizations actually start honing in on this by using a graphic of the days of cash on hand or the months of cash on hand, where they're comparing, well, how much cash did we have at the end of this month compared to how much cash we need, we go through a day or we go through a month. And the value of doing that kind of calculation is that you can watch it change and you can see our cash position is improving or our cash position is deteriorating by not thinking about the total dollars of cash, but by thinking about the days of cash that you have on hand, the days of cash that you can cover. And did you want to add anything to that, Judy?
Nope, you got it.
Okay. Well, so now I was about to jump ship here and switch to talking about the managers. I really do think if you're the executive director, the reports that you're going to look at every month have to go program by program. You need that program statement that shows revenues and expenses for the current period and the year to date compared to a budget, and you're going to work on the projection after you review that. Now, I said program by program here, but in fact, you also need to think about it grant by grant, and that's what we were talking about this morning. It's not either or, it's both. You have to think in both ways. And one of the things that can make it a little more complicated is that some grants do not directly tie to the organization's fiscal year. Some grants started before our fiscal year began, or they're going to end after our fiscal year ends. And so what I've found as a manager, yes, I can print out, if I'm doing program financial statements, I can print out program A's revenue and expenses compared to budget. I can do that. But now if I want to hone in on a funding award, I can also print a report that says, okay, here's the contract from VOCA number 101, and here's the budget for that contract for our fiscal year, and here are the actual expenses we've had in our fiscal year. So I can look at that report. Now, if it happens that that award just perfectly matches our fiscal year, it started on July 1, it's going to end on June 30th, then all I need to do is look at this grant by grant fiscal year to date comparison, and I'm going to be able to say, well, are we doing okay with this VOCA contract? Are we spending at the rate that we thought we would be spending, or are we having unexpected expenses? But if you've got some awards that don't line up with your fiscal year, you're going to need a different kind of report. You're going to need a report that lets you compare the grant to date to the full grant budget, because the reporting you're going to be doing for those grants does not start on July 1. It starts whenever the grant started. So let's look at a sort of big picture of this. So when I'm talking about a fiscal year-to-date program actual to budget, this is what it's going to look like. The year-to-date, the annual budget, the actual budget as a percentage, and then I'm going to fill in the blanks here as a manager with the projected year end. But when I switch my focus to thinking about our grants or awards, I'm going to require my system to give me the grant expenses and income to date compared to the grant budget as it appeared in our annual operating budget. And I'll look at that as a percentage, and I'll be asking myself, is this grant or contract proceeding as planned, or has something happened here? Have we had an unusual expense? Have we had a slowdown? But I may also want to have a report that goes back to the beginning of the grant. And so that's what I'm actually showing here, is that this was the grant budget, not the budget that is in our fiscal year necessarily. This is the whole grant budget, and this is the whole grant to date. And in order to produce this report, I have to have an accounting system that will let me reach back into the prior fiscal year. Now, QuickBooks will allow you to do that, and MIP and the others, they will allow you to do that. It depends on how you have it set up. If you have it set up so that you can't do that, you can't reach back into the prior year, then you're going to have taken the year-end grant position as you open this fiscal year and produce this report on a spreadsheet doing some calculations. Now, I'm about to change the subject, so I want to be sure that we don't have questions on manager information. I think probably the most important thing here is this understanding that if you're the executive director, you have a need for more detailed information. You need it program by program with a comparison to budget. You need it grant or contract by grant or contract on the fiscal year framework. And if you do have some agreements that don't match your fiscal year, you're going to have to be able to look at the agreement as a whole, because that's how you're going to be doing the reporting, and that's how it's going to be decided whether you overspent or underspent is on the agreement from its time period, not your fiscal year. And with that, I think I'll shift gears and talk a little bit about some of these accounting changes. And I don't want to try to turn people into accountants, but I think there's some things that, because nonprofit accounting and nonprofit accounting standards are changing really dramatically right now, I think as executive directors, you should be aware of some of these changes. You know, for years, this standard setting body, the Financial Accounting Standards Board, really did not give a rip about nonprofit organizations, and they just were so disinterested that they would adopt new rules, and they would say, well, these are for businesses, and basically who cares about nonprofits. And now suddenly we're hot and everybody is very interested in us. And so the FASB, the Financial Accounting Standards Board, is like working on rules for us. And they get to promulgate these rules as GAAP for the United States. And in a way, I mean, I think the typical response to that is, so who cares? Well, the answer is that the CPAs who you hire to do your audit, they have to be aware of these rules, because to them, the essential question that you are paying them to answer is, did this organization present its financial information in a way that is consistent with the accounting rules for nonprofits? That's what they're trying to figure out. And so it would be helpful if you got to know what those rules were. And the other thing that is relevant here, even though it's a different organization, this is the American Institute of CPAs. It's not the same thing as FASB, but they get to set the rules for auditing standards. So they make the rules for what is a well-done audit and what is a substandard audit. And that has to do with what the auditor did, not what you did. But these two things kind of come into play. We're going to talk a little bit about both of them. So you may not care about this, but FASB does have a whole process for how they make these rules. And so they went through that whole process and they came up with a really big set of changes that were effective in 2018. So all of us should have implemented these changes by now, because that was for fiscal years that began in 2018. So everybody should be doing it. They came up with some other interesting new rules that are being implemented right now, fiscal years that began in 2019. So a lot of us, that would be the year that we began, July 2019. Yeah.
So, Kay,
Judy?
If a person wanted to learn about these things, do you recommend any kind of, is there a webinar or recording or a book or website where a person could go and learn about these?
I got two ideas. There is a very interesting website that you can go to. You go to the American Institute of CPAs. It's a membership organization, and it starts out looking like, well, I can't see anything here because I'm not a member. But it turns out that this not-for-profit section that they have on the website is actually open to non-members. And they have some really good resources that are free. They have a lot of resources for boards trying to understand financial statements, and they have some fairly good information for executive directors. So I would start there, although, it's like all these membership websites. Sometimes the thing you most want is behind the paywall and you can't get it. So if you run into that kind of problem, ask your auditor. They're a member. They can get that stuff for you. There's also, and I'm going to step away from the camera for a minute, and I hope I can hold this up so you can see it, because this would be something of some interest to the accountants in our group. If you haven't seen this, I'm holding it up, but you probably can't read the title. I'm going to tell you the title. This is the AICPA's Audit and Accounting Guide for Not-for-Profit Entities. It's what they call a desk book, and it's only like $69. It's not that expensive, and it really goes through all of these rules and gives some pretty good examples of how would you apply that rule. So, and I can put that on a follow-up email of how to get that book, but I found that pretty helpful. And there's also some classes, so maybe I'll put that in the follow-up email too, because there are some, the AICPA is doing classes constantly, but they are droners. I mean, that's all I can say. And you might find some classes that are put on by an organization called FMA that we talked about this morning. They're the ones with the template for doing the budget. They have some classes that are a little more accessible. So I'll put that into the follow-up email. Now, I just want to do a couple of quick review items that these first things everybody should be shaking their head saying, oh yeah, I saw that, I understand that. This is the change that we made when we went from having 3 classes of net assets, unrestricted, temporarily restricted, and permanently restricted, to 2 classes and changing the names. So we now have the net assets without donor restrictions and the net assets with donor restrictions. And, here's the idea. In the without, we have the undesignated, just what we've accumulated with no donor restrictions. The without also includes the portion of our net assets if our board has designated them for a purpose. Some boards have ideas about designating a portion of the net assets for like emergency assistance for survivors. And before we had access to special funding for that, some were setting aside money because they knew there were situations where actually no grant was going to pay for it, but they wanted to pay for it. Sometimes what the board is designated for is they are trying to build up money that they're going to use to purchase a new capital asset. So that's a type of net asset without donor restrictions, because boards can't restrict the net assets. They can only designate the purpose for some special purpose. And the other thing that I think is very helpful, particularly if you own a shelter building or you own any facility, is to break out the portion of your net assets without donor restriction that you actually have invested in fixed assets, the land, building, and equipment, so that everybody is clear what portion of your net assets is tied up in those physical assets. Now, in the separate category of net assets with
So, Kate, so if an organization had like a donor, like a board restricted fund for roof replacement, or
yes, that would
replacement,
if
that would
it's
be
board designated. If the board designated, it's going to be in the without donor restriction.
Okay.
If a donor restricted it, it's going to be over here in the with donor restriction. It's going to be a purpose restricted net asset.
Okay.
So it's a really big distinction between, was it a donor that put the restriction or was it the board that did a designation? And depending on which it is, the rules are different. Because if the board has designated something, it can undesignate. It can say, no, we're not interested in that anymore. Whereas if they accepted a donor's gift restricted to the roof replacement, they can't change that. They agreed to do it. Okay, I threw in this sample balance sheet because it has the newer language, the total net assets without donor restriction and the net assets with donor restrictions. And I just wanted to be sure that in saying that we've made these changes, everybody understands that there isn't any change in the need to track restrictions carefully and to maintain a record of all the funds that meet the category of donor restricted that you get, and be sure you're tracking additions to that and releases or the use of that. And it's going to show up in your net assets with donor restrictions, but nothing I've said should take away from the need to keep tracking. We accepted a restricted gift, and here's how we used it. And I mention that because we're going to talk about some changes that may initially seem like they're pulling away from that idea, but they aren't. Okay, so one of the big changes is that the accounting rules try to get greater clarity on the distinction between what they call revenue from contracts with customers and what they call contributions. Now, you might say, well, that's just language. I don't care. It does make a difference because the way that we record income from these two different things, the contracts with customers and the contributions, there are different rules for when you have to record having received income. So it does matter. And the core concept here is that if you're talking about something that is a contribution, it could either be restricted or unrestricted. So I contribute to Bradley Angle House, a shelter here in Portland, and I would never make a restricted contribution because I know what a hassle it is. I always send my gift without restriction. But other people, you know, who I think are nuts, decide, well, I'm going to restrict my gift. You know, it's only to buy, you know, beautiful toys for the children's program. and it's like, whatever, you are causing an accounting hassle by putting that restriction on. So contributions, either restricted or unrestricted, when we have exchange transactions, and that's where we're providing something for a fee, it's by definition unrestricted. And the thing that is weird is that some government contracts are considered exchange transactions, and they would all say, no, we impose restrictions, but that's not what the accounting profession is talking about. So I'm going to try to make that clearer in a couple more slides, because it is frustrating. So the first thing to understand is that, you know, you start reading your agreement with a governmental entity, it doesn't matter what word they use. They can say contract, MOU, agreement, cooperative agreement. They can use whatever word they want. That is not what defines how it's going to be recorded. It's the nature, the substance of the agreement. And the first possibility is that the agreement is an exchange transaction in which you're going to receive a payment which is commensurate with what you're providing. So that's a possibility, and that would mean it's not a contribution at all. Now, the thing that really helped in these rule changes is they decided to be much clearer in how they think about government funding. So before these changes, there was this concept that said if the activities were carried out for the benefit of the general public, rather than to obtain goods and services for the government's own use, we were to follow the rules for an exchange transaction. So let's say that a county government decided that a thing that the community needed was an emergency shelter. And so they are going to award funds to your organization to run this emergency shelter for the benefit of the general public. So under the old rules, we would say, well, you weren't providing the shelter to government workers. You weren't being paid to provide a place for government workers to live. So we're going to say it was for the general public. It's an exchange transaction. But now we don't say that anymore. We say that government funding that provides benefit to the general public, like, you know, the county says we need an emergency shelter, that is by definition not an exchange transaction. It is a contribution. And so the only question left is, how are we going to record it as a contribution? And a first question is going to be, is the contribution restricted or unrestricted? Now, if I were talking to someone from a governmental agency, they would say, that is not a question. We never give money away without restrictions. But again, that is not how accountants think about it. So the clarity is, if you're being given money by the government to do something that benefits the general public, it's not an exchange transaction, it is a contribution. The only time you would have an exchange transaction is if you were actually providing services for the benefit of a governmental unit. And I have seen this occasionally in sexual assault and domestic violence programs, where a police department pays a domestic violence or shelter program to train police officers in how to deal with victims of sexual assault. So that could be an actual exchange transaction, because it's being purchased for the benefit of the government employees to get them training.
So, Kay.
Okay. So, yeah.
So for example, if a organization had a contract to provide training just to child welfare workers, or to the local systems employees, then that would be an exchange transaction. But if it was to provide services to all TANF recipients, you know, that's
public benefit
contribution. Okay.
Yeah, and so another contrast would be one type of payment agreement would be, we're hiring you to do this training for the police officer. So that would be an exchange transaction. Another type of training would be, we want you to educate the general public about the issues of working with victims of domestic violence. That's for the public benefit. So if you've got one of these contracts that is actually an exchange transaction, you're providing a service to the government, this is the stuff you're supposed to do, and you're supposed to recognize the revenue when you satisfy the performance obligation. So that would mean that I'm not going to recognize the revenue recorded as income until I do those trainings for the police officers, and then I can count that as revenue. And if they send me the money in advance, I'm going to treat it as a payment in advance. I can't call it as a revenue until I actually perform on the contract. Now, this is the really new thing that is in a way helpful, and in a way it's just like, really? This is the concept of conditional contribution. So now we're laying aside the idea of exchange transactions. We're not talking about providing services that benefit the government. We're back into the world of services that benefit the community at large. If it's a contribution, it might be restricted or it might not, but this is a different thing. This is not about being restricted. This is about deciding whether the contribution is conditional. So we're all familiar with the idea of a restricted contribution. A restricted contribution, the donor gets to say you can only spend it for this purpose and on this kind of expense. But this is a whole different sort of lens we're supposed to look through, and it's about whether there is a condition. And so the way they describe this is a condition is when the donor requires the recipient to overcome a barrier. That's the first part. And the second part is the agreement has to say that if the recipient fails to overcome the barrier, the grantor, the donor, is released from the obligation and can demand the return of the funds. So a conditional contribution is all about these performance barriers. And you can see a list of what these performance barriers are. So why this matters is that if we determine after we read over those performance barriers and we read the agreement and we see, oh yeah, it says this gift is conditioned on certain things happening, then we have to understand that we can't record this gift as income until we meet the conditions. So what is the situation where this could actually impact one of our organizations? Well, if you're getting multi-year foundation grants, that's when it's really likely to have an impact. So I know some of you have gotten 2 or 3 year grants from large foundations, and you've been told in the past that when you get that award letter that says, hey, we're giving you $300,000 over 3 years, you're supposed to record the gift at the date of the award. And now there's a new twist. Do that unless that agreement is a conditional agreement, in which case don't record the gift until you meet the conditions. Now, restricted contributions may require the return of the money if you don't satisfy the restriction, but that doesn't make it conditional. The thing that makes it conditional is that there has to be some barrier that's included in the gift agreement. And if you don't have that conditional thing going on, you're back to the rule that we've all learned now, that if you get that multi-year foundation grant and it may be restricted for certain purposes, but if there's no conditions, you're going to record the whole thing, all 3 years, at the date when you get the grant, when you get the award, not when you get the cash. Now that's a long and complicated subject, and I can send you resources on that. But my purpose in including this is kind of a heads up. Things have changed in those multi-year foundation grants. And I want to say one other thing before we kind of leave that subject. Many of us get a lot of government agreements where absolutely, the intention of the government is to restrict those funds for specific purposes. But in accounting talk and how we present it on the financial statements never shows up as restricted income. And that's because these are reimbursement agreements. And what the agreement actually says is that if you spend these dollars for this purpose, then we will reimburse you. And if you don't spend these dollars for these purposes, we won't reimburse you. So because of that, by the time you actually are able to record, hey, I'm sending an invoice off to DSHS for $10,000 for expenses I had this month, fulfilling the requirements of that award, by the time you've done that, you have already fulfilled the restrictions. And I know that's kind of a mind blower, and I could talk more with the accountants about why that's true. One other thing to talk about before we just lay this whole thing to rest and get on with something else. We talked about this a little bit before, that board designated net assets. And I'm sorry, I did not correct a typo here. This refers to a different kind of organization. So you can just read that as the organization needs to have actual policies and practices regarding board designations. This is a new requirement that, particularly if you do have some board designated net assets, you need to have a written policy about, well, what are we supposed to do with those and who's authorized to decide to spend them. But even if you don't currently have them, you probably should have a policy about, if our board did designate net assets, what would be the rules governing them. And this brings us to one of the newer requirements about liquidity. And I suspect that some of you may have had this conversation with your auditor during last year's audit, because there is a new requirement that you must include in your notes to your financial statements that are presented in the audit a discussion of whether you're going to have enough cash, enough liquid assets to meet your operating expenses for the coming year. So suppose you were an organization like the one we were looking at in the sample, where their cash is going down. It seems like they might be going to have more and more trouble meeting their operating expenses. They're going to have to make a case to their auditor about why they really will have enough cash available. And the auditor has to be persuaded that that is likely to be true, or else they're likely to have to give a comment that says this organization may not have enough cash to continue its operations. And you do not want that kind of comment from your auditor. This is just the disclosure that what the auditor has to say about it. So I wanted to put that in just to, if you are worrying about cash, and some of us may get more worried about cash as we go forward with this virus crisis. If you are worried, you do need to start thinking about whether your cash position is so seriously problematic that you're going to have to persuade your auditor that you will have enough cash to continue operations. And one of the tools for doing that is a cash flow projection. And I think I have a sample in here, but I'm not seeing it right now, so I'm going to keep going and hope that it pops up. Final thing, I don't think this is a big issue for the larger organizations, but I'll mention it, that there's new pressure on the auditors to demonstrate that they are independent of the organizations they audit. And what this is an issue about is if maybe you're not keeping up with these changes in accounting standards, maybe there's nobody on your staff who really fully understands these rules and can write the notes to financial statements that would explain how you're following these rules. That's not unusual in our field, that people can be doing a great job in accounting and producing financial reports, but they just don't have this formal accounting jargon and they're not keeping up. So the problem is this. It used to be, I used to audit, and when I was an auditor, I can tell you every single nonprofit I audited, I prepared the financial statements for. I wrote the notes, I put them in GAAP format. That is totally not allowed today. An independent auditor cannot do that for you, and they're being pressured to stop doing it. And so some of them are going to be saying to you, you need to hire a third party to get these statements prepared in a formal way, and then I'll come in and audit them. So don't be surprised if that conversation comes up. And the third bullet here is one to pay attention to, because some of the auditors are now saying, well, okay, that was great. You hired a third-party accountant. They came in, they prepared the statements, and that would be fine, except remember, they're your statements, and you need to have somebody on your staff or on your board who has enough knowledge to know whether this third party has correctly represented your organization. And you may not have somebody on your staff who can do that. It is a good job for a board member, something I do often as a board member, that I will sit down with the auditor and I'll go over what the third-party accountant prepared, and I'll explain that, yes, these do represent what's going on here. It's another reason to get someone with accounting background onto your board if you're in this situation. Now, some of you are large and you have an accountant on staff who's not going to have any problem with this. Now, this is just a little table of what all these changes are. So, you know, if you're really bored and now that you have to work at home, you could like look up all these pronouncements and read them till you were just in a stupor. So we have given you some discussion questions. Did not have that cash flow projection slide in this slide deck. And so we're probably going to need to supply that as one of the follow-up email things. But we do hope that you will take some time to have a discussion with your team, and that you will remember that at the end of the discussion, the goal we're after is that you will actually think about any questions you have or any needs you might have to have some one-on-one follow-up on these topics. And the other thing I would just mention is that we skipped the first section of this slide deck. And if you are an organization that has not just funds that you receive from the state that have federal dollars in them, but you also award funds to other nonprofits, you may have some very specific requirements. And there's a very extended discussion about how to tell whether you are subject to those requirements and what the requirements are. And it's at the very beginning of this slide deck. So if you know that your organization takes some of the money that you receive from your governmental contracts, and you know that in some of those contracts, there is federal money, possibly mixed with state money and county money. And you know that what you do is take some of that money and award it to another nonprofit organization. And this happens a lot in rural areas where you can't get out to deliver the services in a remote area. And so you award funds to an organization that is there. If I'm describing your situation, be sure you read those first few slides, because there are some very important requirements for you in terms of how you handle that relationship with the organization that you are providing funding for. And with that, we probably should stop, I think, and maybe take some questions if people want to stay on and ask questions. But Judy,
Sure.
are there other things that you want to say?
A few things. One is, could you just touch on the 10% de minimis MTDC? Is it correct to just take a straight 10% and back it out of the total? And if it's not correct,
It's not.
then what should you do instead? Because this, I think that this is something that comes up with people who have DSHS or other state contracts, OCVA.
Okay, so the issue, the first part of that question is, is the agreement that we're talking about, does it have federal dollars in it? If it does have federal dollars, even if they're combined with state
Yes,
dollars,
it does.
it's subject to the federal rules. Okay, now what the
Very
federal
likely.
government has said is that nonprofits may choose to use the 10% de minimis rate, and what that means is 10% of the modified total direct cost base. That's the MTDC. And that is not the same thing as 10% of the total contract in every case. And there's a methodology that has to be used to compute what is in that base. And the slide deck that I sent to Tess in between, and I will send to anybody who wants to see it, goes through step by step on how you do that calculation. Now, an interesting thing that has just happened is that the Office of Management and Budget, which is the federal agency that puts these rules into place, they are in the process of revising the rules. And in the proposed revisions, which we'll know probably by June whether these revisions are going to be adopted. In the proposed revisions, there's a very good clarification, very helpful clarification that says that if a nonprofit organization chooses to use the 10% de minimis rate, they do not have to prove that they had costs that equaled 10%. They can just use the rate. But what they do have to prove is that they didn't double dip. They didn't also charge costs that should have been covered by the 10% as direct costs. They didn't bill both the costs as direct costs and then bill the 10%. So the issue, why does it matter how you're supposed to compute this 10% modified total direct cost? Well, you have to know what it is in order to know which costs to put in and which costs to not put in, and go ahead and bill as direct costs, not as part of the 10% de minimis, so that you can prove you're not double dipping. So what would I do if funder said, you know, you can use the 10% de minimis? I would use these slides that I'll send you to actually drop my financial information into this example and find out what really is my indirect cost rate using the modified total direct cost method. Because if what I found out is that my actual indirect cost rate is, let's say, 20% using that method, I don't think I would settle for 10%. Because I would lose, and I would have to be raising restricted funds to cover the difference between what they were paying me, the 10%, and the actual cost, because I shouldn't be billing costs that should be included in indirect as if they were direct costs. Then I could be accused of this double dipping. So it would be worth figuring it out. On the other hand, if I worked my numbers through this sample calculation and I concluded, well, actually, my indirect cost rate using the modified total direct cost method, my rate is actually 9%. I would absolutely use the 10% method because I get to keep the difference and I don't have to prove it. So the only way to know whether this is good is to actually work your numbers through the sample and find out what your rate really is.
So we're getting a lot of requests for these special slides on this
Yeah,
topic.
So can I give them to you and
yes,
you
and then
distribute them?
I think that
okay.
We also, I think that DSH has been transparent that there's been several audits from the state and the feds at both DSHS and OCVA, and of course these kind of topics, including on the de minimis or MTDC, is of great interest to auditors. So let's maybe we'll have a little pause where we check in about that, and then have some good advice out for the field. Just because of time, and we might, who knows, we could even do a separate short webinar just on this topic, since it's making my head explode. And then we had these afternoon discussion questions, which I'll just get up here for a sec. Yeah, I'll get it up. I'll try to get it up here. Thank you very much for your time. And really appreciate people hanging in on this
Yeah.
great topic. And thank you for your really important work in the community. And want to thank especially, we have a lot of contact with EDs and program managers, but I really want to thank the fiscal staff who are on here who, I don't know if you get to talk to each other very much, but your work is so important, and really appreciate you every day what you do.